Hey guys, if you're looking to buy proven and successful CVs, cover letters and personal statements, as well as tutoring and consulting for breaking into finance or for school more generally, be sure to check out ASURE.uk, the link is in the description below. Hey guys, welcome back to the channel, and in today's video I want to talk a bit more about what private equity is. As you may know, I am an infrastructure private equity analyst, and I've been working at my firm for about 3 or 4 months now, and I thought it would be good to reflect on my time so far. But before I do that, I thought it would be a good idea to kind of explain what private equity it actually is. It's a pretty unknown field even for people who work within finance, so I thought it would be quite good to demystify it a little bit. So without further ado, let's get into the video. So I work in infrastructure private equity, which is kind of a subgenre within the wider private equity space. So in order to explain that, I'm going to first explain what private equity is more generally. Private equity is a buy-side role where you're basically trying to earn either a stake or the entirety of a privately listed company, i.e. a company that isn't listed on a public stock exchange. As a side note, you technically could purchase a publicly listed company and turn it into a private listed company, which is known as a take private, but that's a bit technical and it's not for today. But if someone wants me to create a video on it, I can do. Private equity firms look to identify companies where they feel there's room for improvement. So that could be that, the company isn't being well run right now, it's a bit distressed, they think that the management team isn't kind of properly looking after the company, or there's a tailwind that means that the company is set to grow in the future that hasn't been harnessed or kind of realized yet. And so we look to kind of identify these sorts of companies, buy them at a cheap-ish price, and then hold them for a period of time in which they try improve the company, develop it, make it more efficient, make it more profitable, and then after a certain period of time, they'll look to sell it for a profit. Private equity firms look to buy these private companies using a lot of debt, otherwise known as leverage, in something that is known as a leveraged buyout or an LBO. And the reason that they do this is that they use debt to try maximize or boost their returns. If you're using debt, you need to you're using borrowed money, so you need to put less of your own money down to fund the acquisition. And that means the profit relative to how much money you've actually put in is a lot higher. And so this can boost your returns. You might be wondering where private equity firms actually get all of their money to invest into these companies. And normally they receive money, also known as capital, from a bunch of large institutional investors. So think insurance firms, pension funds, sovereign wealth funds. All of these sorts of companies will provide their money and look for the private equity firm to provide them with a large return. So what a private equity firm does is they pool all of this money that they kind of get from a bunch of different investors, they pool it all together into something that is known as a fund. They then use the money in this fund to then invest into various different companies or assets. Private equity firms, in terms of how they actually make money, is in the form of 2 different sets of fees. One is a management fee and the 2 is a performance fee. So the management fee is basically money that the private equity firm charges just for handling the money that the investors, their limited partners, have provided them. So normally that's something around 2%. So say, for example, I've provided a private equity firm with 100 million in capital. 2 million of that capital automatically goes to the private equity firm as a management fee. If in addition to this, they also charge 20% of whatever is earned above a certain target threshold of return. Let's say, for simplicity's sake, that the private equity firm has a target return of 10%, meaning that it has told its investors that on average every year it will make a 10% return on their money. Now, let's say that they in fact massively outperform this 10% and actually make a 20% return on money. So that's 10% above what this target rate was. So then the private equity firm will take 20% of the difference between 20 and 10%, which is 10%, as a performance fee. So 20% of 20 minus 10% is 2%, and so that 2% additional return will go straight to the private equity firm. And this is basically a way of incentivizing the private equity firm to, make good, solid investments and make the best investments as possible. It's trying to align kind of the private equity firm's incentives with that of the investors. So infrastructure private equity is pretty much the same as core private equity. The only difference is that we only look at a certain type of company, infrastructure companies, because they possess certain kind of characteristics that we think are quite attractive. So infrastructure companies, such as your water and gas companies, as well as something like toll roads, they're meant to be quite safe and stable investments because they provide services that people use every single day. Like, we don't go a single day without using the water and gas in our house pretty much, right? And so because of that, people have to use these services. And so they're always pretty much going to generate a revenue or cash flow for the private equity investor. What's more, often the firms, like the companies providing these infrastructure services, often benefit from a lot of regulatory protection. Sometimes they are licensed by the government as the only firm that can provide that particular service, or they'll just be natural monopolies where it makes sense to only have one of these firms to provide the service because of things like economies of scale. And as a result of this, either due to government legislation or just through sheer market forces, there will literally only be one of these firms. And so the kind of element of risk through competition is very much mitigated. It's very unlikely that, a startup is going to be able to recreate an entire water network that's large enough to, let's say, supply for the entirety of the UK. It's just very unlikely. And so when we make these investments, we can be pretty sure that, this business isn't going to be taken over or going to be run out of the market by some new competitor. So as a consequence of all of these kind of characteristics, it means that infrastructure companies are able to provide very, very stable cash flows and dividends year on year on year. And so these features are very attractive for firms or investors who are looking for, safe and stable and decently high returns. Might not necessarily be as high as what you'd get from core private equity, but you're also having a lot less risk. In case this industry sounds pretty exciting to anyone listening, I thought it'd be good to just go over how it's actually possible to break into the private equity industry. So private equity is actually seen as one of the more lucrative or prestigious areas of finance. It's what a lot of investment banking analysts look to transition into or lateral into after doing a few years in investment banking. The reason for that is that the lifestyle in private equity is a lot more sustainable or less draining than what it is in investment banking. And also the salary can be just as good, if not better, than investment banking based on what firm you go to and how good your returns are. In a lot of cases, private equity firms will only actually recruit experienced hires, which are basically people who've already done a few years in the finance industry. However, there are a certain few firms, especially those in the kind of more niche areas of private equity, so your infrastructure or your real estate private equity, that will hire straight out of university. I happened to intern at one of those firms last summer, did the internship, converted the internship, and now here I am as a graduate.
Hey guys, I somehow managed to forget to record an outro conclusion to the video. So if you did enjoy the video, please give it a like, subscribe to the channel, give it a share to send it to anyone who you think might enjoy it or benefit from it. And let me know down in the comment section below what else you'd like to see from me.